Thank you for joining us today for our member webinar with Axel. My name is Jolene Olson. Outside this webinar, feel free to email me if you have any questions regarding your membership or the TechChart service. You can reach me via the Contact Us link that's on the website. All right, welcome, Axel.
Thank you, Jolene. Hi, everyone. Thanks for joining us today. So this is our last webinar of the year. And we will be basically discussing several charts, several concepts. So the aim of this webinar is going to be bringing or refreshing perspective on classical chart patterns with different time frames. Tech charts started featuring chart patterns in duration between 1 month to 3 months on daily scale price charts, as well as 4 months to 24 months on weekly scale price charts. So by focusing on short-term chart patterns, we are basically trying to capture what long-term weekly scale price charts are missing. And by looking at long-term weekly scale charts, we're basically trying to find major inflection points that short-term charts cannot capture. So what we will do is we will start with what are the common things between chart patterns on daily and weekly scale. So several of those charts were featured in the Global Equity Markets report as breakout alerts or on the watch list. Every week you will see two sections on the report, which is one of them is showing the breakout alerts from the stocks that have completed their chart patterns from the watch list. And you're also seeing new additions to the watch list. Now, some stocks come into the watch list but do not qualify for a breakout for several weeks, and some morph into other chart patterns. So let's say, for example, we have 20 names in the watch list. Next week, we might not have 25 names in the watch list. Some 2-3 names have morphed into some other chart patterns. For example, the stock started forming a cup with handle chart pattern and then failed and went into a rectangle formation. So those things are basically not in the watch list during that time. But when there's a breakout from a rectangle, we bring that to the breakout alert section as a rectangle breakout, or we comment on it as a rectangle chart pattern, and then the breakout takes place. So let's look at, for example, a couple of chart patterns that I like to focus on, and we will now see the daily and weekly scale price charts of different chart patterns and look at what are common things with those. First of all, appearance of pattern. This is gonna be very similar on weekly scale price charts and daily scale price charts. Let me define what daily scale price chart is and weekly scale price chart. Now, any charting software will allow you to chart price action in different time scales, be it intraday, daily, weekly, monthly, quarterly, and so on. My default time frame is weekly scale price charts, looking at trying to find chart patterns on weekly scale. When we say weekly scale, each bar is 1 week's price action. So Monday till Friday, trading takes place. The opening of Monday, the closing of Friday, that is recorded as one candlestick. Whereas if we move to the daily scale price chart, the daily scale shows 1 day of price movement. So let's say in the morning, the market opens, there is an opening price, there's a low price, there is a high price of that day, and then a close. So that 1 day's price is recorded as one candlestick. Now here you're seeing Walmart's price action, which formed a 3-month long cup with handle continuation. Okay, so this is the cup part, this is the handle. So this bar here is actually 1 day of price action. Now, appearance of pattern, you will see that on weekly scale and on daily scale are going to be the same. Breakout is going to be the same. Breakout above a specific well-defined chart pattern boundary with a strong candlestick. This is going to be the same. Several tests of chart pattern boundary on weekly scale and daily scale. On the chart patterns that we are looking, you will see the same patterns repeating. several tests of chart pattern boundary, and then the breakout taking place. We will go through other charts, and I will repeat those if you want to take note. A setup above or below the 200-day. Now, when I'm writing the reports or commenting on Twitter or in the webinars, I like to mention that I use the 200-day moving average as a trend filter. So what I like to see is bullish breakouts, bullish completions above the 200-day moving average. In this case, Walmart's cup with handle took place above the 200-day moving average. When we see bearish chart pattern completions, this should be below the 200-day moving average. Why is that? Because it is the path of least resistance. When we have price action moving above the 200-day, we are in an uptrend. So uptrends pick up momentum by completing bullish chart patterns. So we want to participate in that breakout and the momentum period. So then the next common thing is the general context of price action with regards to the chart pattern in focus. You're looking at a weekly scale price chart or a daily scale price chart. The same thing you will see is that bullish chart patterns will form after a previous uptrend. So the previous uptrend should be there, the continuation chart pattern will form, and then the breakout will take place. Cup with handle will not form at the bottom of price action. So the general context of price action, if we're looking at a rectangle in an uptrend, prior trend should be up, rectangle, and then the breakout. Now, this is important. This is something that might be helpful, and you can fine-tune it according to your way of looking at markets and trading. Number of price data on a chart, or let's say bars on a chart. Now, we are, as chartists, it's a visual exercise. So unless you code this into a computerized program to detect chart patterns, which I haven't come across, that detects different duration chart patterns and on the different time scales, unless you do that, it's a visual exercise. It's an eyeballing technique. So we have to train our eyes and not get confused with the significance of what we are looking at. For example, if you keep on loading, my recommendation is this: 5 years of data on weekly scale and 1 year of data on daily scale. What this will allow you is to see approximately 220 to 250 candlesticks on one screen, a clean white background chart or your preference black background, but the same number of candlesticks you're seeing. So when you see this 3-month long cup with handle continuation on a daily scale price chart, and then the next chart you open is a weekly scale price chart, there is some kind of a symmetry. There is some kind of similarity, apple-to-apple comparison in terms of duration, in terms of the significance in historical perspective. So number of price data on a chart will be the same on the weekly and on the daily. If you take 5 years of data on weekly scale and 1 year data on daily scale, this is my recommendation. You can adjust it, as I said, according to your needs. So this is the Walmart price chart, 3-month long cup with handle on a daily scale. Let's move to the next one. 200-day moving average is plotted on the price chart. Now you will see a similarity here. GCI Liberty, another company from NASDAQ, a clear uptrend, cup with handle, breakout takes place, price continues higher. 200-day moving average. 1 year of price data, November to November, approximately, give or take. So we're talking about 220 to 250 candlestick on a price chart. Next one, Applied Materials, cup with handle again. This was another chart that was featured under the watch list and the breakout alert section as well, reached its price target. So we have a clear uptrend. The uptrend develops and eventually forms a nice cup with handle above the 200-day. Now, a common question that I receive is it possible to analyze the price chart at every single point? No. For example, February till May, there is no clear chart pattern here, and the price action is violating up and down around the moving average. So why not wait for a more clear chart pattern development such as this, where you clearly can see a horizontal boundary being tested several times, and then the breakout takes place. Now, you can see the appearance of the chart pattern that is similar to the previous ones. The breakout with a strong candlestick, several tests of chart pattern boundary, set up above the 200-day moving average, general context of price action, prior trend is up, and then the consolidation, and then the breakout. Something that I have discussed with other members is that when we are applying classical charting principles, we are basically looking at consolidation periods, and we're trying to capture the trend periods that follows those consolidation periods. So the more defined a consolidation period that pops up in your face when you open a chart, the more significant the chart pattern that you are identifying. Because the breakouts that take place from those well-defined ranges usually result in a trend period. Whereas if you're looking at something that doesn't actually have a clear chart pattern boundary or a horizontal well-defined consolidation, the breakouts might not lead to a price action because those type of consolidations are actually not recognized by the market participants. The more a boundary is tested, the more clear it becomes, the stronger the more important the chart pattern, and the stronger the participation in that chart pattern when the breakout takes place. Now let's have a look at the longer term breakouts that took place. This was again another chart pattern that was featured under the breakout alert. Now you can see a year-long cup with handle. Unlike the 3-month long, we have a similar chart pattern setup, this time on the weekly scale. As you can see, the 200-day moving average is again helping us to filter. So a clear uptrend prior, and then the consolidation, several tests of the chart pattern boundary, horizontal, and then the breakout takes place. Set up above the 200-day moving average, breakout, general context of price action, a number of data. Here you can see 5-year-long history, which is again amounting to 220 to 250 candlesticks on this price chart. So what you're seeing here, year-long cup with handle, would be having a similar meaning on a daily scale price chart or a similar weekly scale price chart. When we look at the next one, here we are seeing 16-month long. Year-long was 12 months. This is 16-month long, a little bit longer than that, but everything is similar. Cup, handle, horizontal boundary, breakout taking place with a strong candlestick, several tests of chart pattern boundary, and the 200-day moving average acting as a clear support and basically helping the price to push higher. So it's telling us that the trend is up. All we need is a clear, decisive breakout from this consolidation range with a strong weekly bar. Or if it's going to take place during that day, a daily bar. Now, when you're looking at this weekly scale price chart, I want you to focus on this period. It's a very small consolidation on the weekly scale price chart. Okay, but if you go into the daily scale, you will see that this is a 2-month long rectangle that broke out, or a flag, if you want to label it as flag. It's a consolidation after a steady uptrend that broke out on the upside. It is more difficult to see these patterns on weekly scale. That is why now we're looking at the daily scale price chart to capture 1-month to 3-month long consolidation periods, basically to increase the frequency of opportunities that we are trying to capture. So the difference here is the weekly scale and daily scale is that it will allow us, if you go to the daily scale, it will allow us to capture those consolidation periods as well. Now this next chart is this was not discussed, but it's a good example to future because the weekly scale price charts that we have highlighted in our weekly report have a similar setup. It's a wheat fund. You can see the 2-month long descending triangle. Now we're going to look at the descending triangles. Again, March to March, year-long data on daily scale. As you can see, the lower boundary has several tests. The breakdown takes place, a steady downtrend follows. Descending triangle being a bearish continuation chart pattern because of its downward sloping up trend line, forms under the 200-day moving average. So the trend filtering is done, trend is down, bearish continuation, breakdown takes place. 2-month long descending triangle. Now let's have a look at the next setup. Another 2-month long descending triangle on the same price, same type of daily scale price chart. Descending triangle. This time the descending triangle is taking place above the 200-day moving average. Something I usually mention is that it is always better to see two technical levels being broken down or broken upwards than one technical level. It shows the significance of that breakdown or breakout. And in this case, if the chart pattern is completing by breaking down the 200-day moving average, it is even better because it's setting the tone of the trend. So the chart pattern that is forming here, being a bearish one, is also clearing the 200-day moving average. So the breakdown takes place, a clear, steady downtrend follows. So these are the consolidation periods we want to focus on to be able to capture those breakdowns. And these are 1 to 3 month long, shorter term chart patterns. Now this was a chart pattern that was featured in the Global Equity Markets Report breakout sections. And first it was a watch list, and then the breakdown took place. Now here, this is a weekly scale. You see a 5-year long history, okay, and a clear downward sloping upper boundary and a horizontal boundary that has been tested several times. The filtering is there, 200-day moving average, which is the 40-week moving average in this case on the weekly scale. Breakdown, continuation of the trend. General context of price action, prior trend is down. Breakdown taking place with strong candlestick. Appearance of the chart pattern is the same, like the daily ones. So you can see the comparison between the daily and the weekly scale. Same setups. In a while we will touch the differences, but same setups. It's just if you start looking at the daily and weekly together, you will have more opportunities, more breakout opportunities, and basically the frequency of those chart patterns that are showing up on your screen will increase. Our next chart is another descending triangle. This was again featured in the Global Equity Markets Report. It was a breakout alert. And you can see that 6-month long descending triangle, several tests of chart pattern boundary here, almost kissing the boundary before a breakdown took place. Filtering is done. 200-day moving average is acting as resistance. At every attempt, the stock found resistance at the 200-day moving average, and eventually we have seen a clear breakdown and continuation of the downtrend. Now here you can see a small ascending triangle, probably a 3 to 4 months long, that formed above the 200-day moving average. So bullish chart pattern above the 200-day, bearish chart pattern below the 200-day. That's the path of least resistance. Our next chart will focus on rectangles. Now, everybody that follows tech charts for a long time knows that I'm a big fan of rectangles. The reason for that is that it's easier to identify on price charts. Second is the it's like the price is like a ping pong ball between the boundaries. The more tests, the clearer the chart pattern boundaries become, and then eventually when the breakout takes place, the price action is strong, and the breakout usually clears all the previous highs in the chart pattern. One of my favorite horizontal chart pattern that I like to feature on the reports. Filtering is done 200-day average. We are settling above the 200-day. It's a 3-month long rectangle. Time period November to November, year-long price chart loaded on the screen. We're looking at daily scale, and the breakout is taking place with strong candlestick and then taking us to the price target. General context of price action, prior trend is up. So this can act as a continuation if it breaks on the upside. Our next chart is a recent, again, a breakout alert that was featured. It's a 2-month long rectangle. Now, this is a wider and shorter time frame. It is a bank in Italy that broke out on the upside. Like the other Hang Seng Bank's price chart, opposite happened. The breakout from the chart pattern also cleared the 200-day moving average. So this is basically more conviction for us that when the breakout takes place, the trend is also reversing. So we are moving into a positive territory. Here, for example, if you look at the left side of the chart pattern, you can see a possible head and shoulder continuation that took place above the 200-day moving average. So bullish continuation, we want to see the price action above the 200-day moving average. That was the case here. After a slight pullback, a couple of days, price continued higher. Our next chart is another breakout alert that we have discussed. This is a 3-month long rectangle, West Japan Railway, a Japanese company. Now you can see there's no way, if you're looking at a daily scale price chart and you have covered maybe 300, 400 names one after another, to miss this opportunity, setting up like this after several tests of chart pattern boundary. It will pop up. It will clearly differentiate itself from the other candidates, other stocks that you have reviewed. That's why apple-to-apple comparison is always good, because if you keep on opening 1 year long data on a daily scale price chart, it will be easier to see what is happening on the right side of the price chart. So the breakout took place, pulled back, continued higher. Clear 3-month long rectangle. General context, a clear uptrend prior to the consolidation. Filtering is done. We are above the 200-day moving average. And several tests of chart pattern boundary is there. And this is a daily scale. Now we're going to look at weekly scale price chart. Can you see that this is almost similar to the Italian bank chart that I have featured 2 slides before? A wide range, shorter, but this time it's weekly scale. It's a 6-month long rectangle. The breakout is taking place, clearing the downtrend line. The breakout is taking place above the 200-day moving average, which is the 40-week in this case. General context of price action. Prior to the chart pattern, the trend is up. Consolidation, breakout. The breakout is taking place in this week. Price is reaching its price target in a couple of weeks. Now, this also was a breakout alert in the global equity markets report. On the weekly scale price chart, we can see the 6-month long rectangle. If you're opening a daily scale price chart, you will not be able to capture it, or if it is a little bit shorter, you will be able to. But the longer the chart pattern, it needs to be reviewed on the weekly scale. My default time frame is weekly, then I move to the daily, and now that several members have asked to see more opportunities from the daily scales, I'm now a little bit more basically adding times into the research and trying to find more opportunities that are clear and well defined on daily scale price charts. If we move to the next one, this is again a weekly scale, another breakout alert that was featured in the global equity markets, Crown Castle International. You can see that the 14-month-long rectangle, several tests of chart pattern boundary. Appearance is the same, a sideways consolidation between the boundaries, 200-day moving average acting as a filter. The breakout is taking place above the 200-day moving average. Now here I have discussed in the previous report and tech chart study section about the differences between premature breakout and false breakouts. So if you're interested, you can have a look at this under tech chart study. There are several great articles there discussing the differences between logarithmic and linear scales, different candlestick patterns, and premature breakout as well is there. So our next chart is another rectangle, 2-year-long rectangle. Again, here premature breakout, and then came the secondary completion. Now, if you're looking at a weekly scale price chart, and you have 5 years of data loaded, and you come to this point, there is no way you can miss this rectangle, only if you're looking at a weekly scale price chart. This was a stock that broke out in Australia. It's an industrial company. You can see the opportunity that it provided for long-term position traders or funds. It was a clear signal to go long. Now we look at another horizontal chart pattern, head and shoulder continuation. This chart was not featured in the report. Not everything is featured. Not everything I'm able to capture as I go through the charts. There are times that I miss opportunities, but the idea of the Tech Charts Global Equity Markets report and the Tech Charts membership service is not to provide alerts to our members. It's to provide a perspective to look at charts so that you can take your research, you can take your analysis and trading to the next step and do those analysis yourself as time goes on. So what we are seeing here is a 4-month-long head and shoulder continuation. Left shoulder, head, right shoulder, a clear neckline, horizontal boundary. I like the horizontal, even with head and shoulder tops, head and shoulder bottoms, head and shoulder continuations, I like to see a neckline that is horizontal. Several tests of chart pattern boundary, breakout takes place, strong trend continues. The breakout is taking place above the 200-day moving average. Now you can see here how nice the right shoulder have found support at the 200-day and continued higher. So this is the type of price action that we would like to see. Now you're going to see a weekly scale price chart, which was featured in the Global Equity Markets report. And it is the exact same setup, but this time on a weekly scale price chart. Now this is an 11-month-long head and shoulder continuation. It's a basic material company from Hong Kong. You can see the several tests of chart pattern boundary. Prior trend is up, head and shoulder continuation left, head, right shoulder setting up above the 200-day moving average here, and then the breakout takes place and takes us higher to the chart pattern price target. So as you can see, when we're looking at daily and then switching to the weekly, as long as we have the same number of candlesticks, the data, we are basically creating an apple-to-apple comparison even between the time frames, which allows us to understand the significance of the chart pattern that is developing. Our next chart is an ascending triangle. This was featured under the review section. The report starts with the review section every week, and I try to look at major benchmarks that are followed by our members. This was an S&P price chart that I shared. It was a 3-month-long ascending triangle, and still the price is continuing higher. The breakout took place here, but you can see how nicely the price found support above the 200-day moving average. After several tests of the chart pattern boundary, the breakout took place. and the trend continued higher. Now this is a daily scale price chart, 200-day moving average, appearance of chart pattern, breakout, several tests of boundary, all of those set up above the 200-day moving average, all of them are common between the daily and weekly. Microsoft was another breakout alert that was featured. It's a 3-month long ascending triangle. You can see several tests of chart pattern boundary, breakout taking place with a gap opening. Couple of days of consolidation, price continues higher. 3-month long ascending triangle. It's a bullish continuation chart pattern, so we would like to see a breakout higher from this chart pattern above the 200-day moving average. So the trend filter is also confirmed. Now this was another breakout alert on the weekly scale that was featured in the report. It is health equity price chart. 8-month long ascending triangle. Now it's a similar setup. Price chart is extending back to 2014, which is covering almost 5 years of data. Several tests of chart pattern boundary. Here, an attempt to break out. Basically, the price is saying that I'm willing to break this resistance because it's hugging the trend line, hugging the chart pattern boundary, and then the breakout takes place. Takes us higher in a steady uptrend. We are above the 200-day moving average again here. This was another breakout alert, 2-year long ascending triangle. This time it's much longer, but the same setup is there. Even the right-hand side of the price chart is another ascending triangle here that completed on the upside at the same level as the larger scale ascending triangle. Breakout took place above the 200-day moving average. After a couple of weeks of consolidation, price continued higher to reach its chart pattern price target. Now we're going to look at head and shoulder bottom. A recent breakout alert from Hong Kong, Kingboard Laminates Holding, 5-month long head and shoulder bottom. Left shoulder, head, right shoulder. The right shoulder is a 1-month long rectangle. This one we discussed in the report. And the breakout takes place, pullback, continuation. Now you're going to see, again, a similar setup like the Italian bank, like Sodexo, where the breakout is taking place at the same time as the price is clearing the 200-day moving average. So 2 signals at the same time. We are basically starting a new trend, let's say we're moving to the bullish zone as we are defining it with the 200-day moving average above or below. So we are moving above the 200-day moving average with a breakout, completing a 5-month long bullish reversal chart pattern. So these 2 signals are important. This was another breakout alert, 9-month long head and shoulder bottom. The general context of price action. Are we in a clear downtrend? Yes. Has the price been steadily below the 200-day moving average? Yes. Did we form the left shoulder, head, and then as we are forming the right shoulder, did we move above the 200-day moving average and stabilize? Yes. This week was a clear, strong week. The breakout week is this. So as you can see, now the 200-day moving average is also reversing. And then this steady uptrend follows. Left shoulder, head, right shoulder. It's a 9-month long head and shoulder bottom. The same setup, the daily and the weekly. Same number of data bars we're analyzing. Okay, now what is different? When we're looking at daily scale price charts, what about when we're looking at weekly scale price chart? What are the differences? Now, members are familiar with the books that we are basically seeing as the Bible of classical charting principles. It's Richard Schabacher's book and Edwards and McGee's book. These 2 are basically are the basis of our analysis. Now, Edwards and McGee is discussing something in his book and their book and saying that a stock should move by a 3% margin above the resistance to be confirmed as a breakout. Sometimes this 3% is too far from the chart pattern boundary. Especially with instruments that have low daily volatility, 3% might be too far away. But here is the thing. This is a trading tactic, so it is not common for everyone. Somebody who is eager to enter into a position on the breakout can jump at the minute of the breach of the chart pattern boundary. There is nothing wrong with that. It's just the possibility of failure increases. The probability of failure increases because daily intraday volatility might result in a failed breakout. So when we're looking at daily scale price charts, this is the difference. Do we take the 3% breakout confirmation? Is it too far from the chart pattern boundary, or should we accept a lower breakout confirmation level? Now, in GCI, there are a couple of levels. First of all, it's good to be consistent. So if you're going to take anything below 3%, it has to be 1%, 2%. Or if you're going to take 1.5%, you should take the 1.5% as you see more opportunities. Also, you need to see how much of an upside it is leaving after that breakout confirmation. If the 1.5% breakout confirmation is still too far from the chart pattern boundary, you can get the 1% breakout confirmation. Now with, for example, FX, this should be even maybe 0.5% breakout confirmation, because their intraday volatility is not that big. Here on this chart, GCI Liberty, I took the 1.5% breakout confirmation because when we looked at the 3% breakout confirmation, it was too far from the chart pattern boundary. So I took the 66 levels, 66.4, the day of the close, confirmed the breakout for me, and it was a signal. It was a breakout confirmation. Now, the breakout confirmation could have been much earlier for other traders, other investors. And this is, as I said, it's a trading tactic. You can apply 1% breakout confirmation or 2% breakout confirmation. But what I want to differentiate here is that with weekly scale price charts and breakouts, you have to allow a little bit more margin than being too aggressive. Because the weekly scale price charts will allow you more upside potential. Now, for example, in this daily scale price chart, GCI Liberty's breakout gave us a 12% upside potential from the chart pattern boundary to the price target. The time that it took for the price target to be reached was 18 days. So this is another thing that is going to be different, that we're going to discuss as differences. First of all, the breakout confirmation level can be a little bit lower. Price target upside potential is usually much larger with weekly scale breakouts because they are completing a larger scale chart pattern. Exposure to adverse price action due to news effect, earnings, fat finger, etc. is higher on the daily scale price charts than the weekly scale price charts. As we're looking at a 1%, 2% move above the chart pattern boundary as a breakout confirmation, the next day you get an adverse movement of 3%, 4%, the chances are higher that a breakout can fail or dip below the chart pattern boundary versus the weekly scale breakouts. And also the time to reach the price target will be different. Now, let's look at the next chart, which is a weekly scale price chart that we have discussed in the previous slides. This is a year-long cup with handle. 3%, you can see that 3% breakout confirmation is almost not even away from the chart pattern boundary. So imagine taking a 1% breakout, it will be too tight. Unless you go and apply some different scaling in techniques, the breakout confirmation will be too tight if you give yourself too limited margin. So 3% breakout confirmation, 181, with the daily close above that level, 182.2 was the close. I'm gonna look at the daily scale price chart in a while. It gave us a good amount of upside potential, being 176, the chart pattern boundary. So the upside potential was 26%. It took 9 weeks to reach the price target. This is 45 trading days. Now, a 26% upside potential on a year-long cup with handle versus a 12% upside potential on a 3-month-long cup with handle. So basically, you can see that the shorter the duration of the chart pattern, the lower the upside potential in terms of percentage. Now the next chart is the Hang Seng Bank. You can see that 1% breakout confirmation is here at 190.8. 3% breakout confirmation is almost halfway the price target. So if you're taking 3% breakout confirmation here, it will be too late of a signal. Can you take 0.5%? It will depend on how you want to position yourself. If you're an aggressive trader, you can take that 0.5%. But again, relative to the chart pattern price target, it's good to see those levels and act on something that is more meaningful on the daily scale price charts. That will allow a good amount of potential to the price target. Now this was a 5.3% move on the downside from the chart pattern boundary, and it took 2 days to reach the price target. It's a short-term chart pattern, 2-month-long descending triangle. Let's have a look at a longer-term descending triangle, 6-month-long descending triangle. Now you can see the 3% breakout confirmation at 12. So 12.4 is the chart pattern boundary. We are not that far away from the chart pattern boundary as a confirmation level relative to the price target. So there is still a good amount of potential that is left after the breakdown confirmation. So the daily close that took place below the chart pattern confirmation was 11.84. It allowed us from the chart pattern boundary to the price target 29% potential. So as you can see, we looked at a similar chart pattern on weekly scale, similar chart pattern on daily scale. One offered almost 3%, the other one offered 29%. But the number of days that it takes for the price to reach the chart pattern price target would be also much longer, 6 weeks, 30 trading days to reach chart pattern price target. Okay, so now as we have discussed the common things and the differences, the last part of this webinar, I want to touch a little bit on the risk and reward on the chart patterns, because there's a little bit of a confusion as members are asking what is the chart pattern negation level and where would you place your stop loss. From the start, I want to say that stop loss is a trading tactic, and you can see that where you place your stop loss will depend on how aggressive you want to be with these chart pattern breakout opportunities. And it's a trading tactic. It will depend on from trader to trader. Whereas chart pattern negation level or the appearance of a chart pattern, what qualifies as a cup with handle, what qualifies as a symmetrical triangle, these are all universal. How do you calculate chart pattern price target? This is universal. This is written in all kinds of classical charting books the same way. So we are trying to touch those things, but the trading tactics will depend on you, will depend on how you want to position yourself, how you want to trade those breakout opportunities. I'm just going to provide some ideas here to show you the potential of those type of breakouts. Now, there is a difference between chart pattern negation level and stop loss. Chart pattern negation level is the level at which the chart pattern will not be called a cup with handle or head and shoulder continuation or symmetrical triangle or ascending triangle anymore. This is a subjective level, okay? And a stop loss is slightly different. While chart pattern negation level can be used as a stop loss for longer term position traders, a stop loss is different, and it is a point where you measure so many things. You measure your risk reward, you measure how much of a position you're going to take in that stock, and so on. For example, let's discuss this GCI Liberty. The breakout confirmation with the 1.5% breakout, 66.4, that day's close. A logical point to place stop loss is below the chart pattern boundary. That's the only thing I can comment on. Now, another logical point would be a minor low, because if that low is breached on the downside, that support is broken basically, other than the chart pattern boundary. So if you place your stop loss at this minor low, which is 63.9, and your entry is 66.4, the difference here added to the entry level, risk reward 1, risk reward 2, risk reward 3. So if price goes to this, you're basically benefiting as much as you have risked. If it goes to risk reward 2, you're benefiting 2 times the initial risk. If it goes to 3, you're benefiting 3 times the initial risk. This is an ATR based trailing stop loss. As the price moves higher and makes new highs, and depending on the ATR calculation, it will move higher. It will never go down. A stop loss should never go down. It will move higher to protect you from any adverse movement. So let's say the price came here and touched the ATR based trailing stop loss, and you got stopped out. What happened in this trade? This trade was a good trade. Nothing was wrong with it, but because of the rules that you were applying as a trailing stop loss, as a trading tactic, you entered here, you were out here. Is this a loss? No, it is not a loss, but this is a trade that didn't reach its chart pattern price target and got stopped out. However, this was actually a trade that went to its cup handle price target. Now, cup handle price target is somewhere between risk reward 2 and risk reward 3. This is 2.5. So entry stop loss 2.5 upside potential. I hope this is clear. Now, let's move to the next chart. The next chart was a weekly scale price chart, but now I opened the daily scale for trade management to see the breakout confirmation level and some kind of a logical point where you can place your stop loss. Now, chart pattern negation level with cup with handle, it's here, 144.6. And you see this day's low, because we don't have a minor low other than that. A logical point could be this, or it could be not a low, much more tighter, close to the chart pattern boundary, but always below the chart pattern boundary. Breakout confirmation took place with a daily close at 182.2. Stock pulled back a couple of days, so your protective stop is here. The minute that stock starts moving higher, your trailing stop loss is moving higher. The multiples that you use for your ATR based trailing stop loss can change. You can use 3 times ATR, 4 times ATR, 5 times ATR. It will just trail the price closer or with a wider distance. This will allow, the wider distance will allow you to capture a bigger part of the trend, shorter multiples, 2 ATR or 3 ATR, because it's going to come very close to the price as the price moves higher. Any adverse movement can hit the trailing stop loss. It will not allow you to capture a large part of the trend, but it is basically a two-edged sword. What you want to capture, what you want to achieve, will depend on your risk profile, how you basically manage those breakout opportunities. Here, I just want to mention that with this weekly scale price chart, with weekly scale breakout, but this is plotted on a daily scale, the cup with handle price target was far away from the chart pattern boundary, that it allowed us 1 to 3 upside potential. So by the time price reaches its chart pattern price target, it allowed you almost 1 to 3, given that your entry is here and your stop loss is this. So those parameters can change. What I want to say here is you can maximize the difference with how aggressive risk you want to take. This could be a 1 to 5 upside potential for some traders. It could be 1 to 1 for some traders. This will depend on how you position yourself and how you manage your protective stop and also the trailing stop afterwards. Thank you very much. This is the last part of our webinar. Now we can move to the questions. I hope it was clear. Jolene?
Thank you, Axel. I'm going to start sending questions.
The first question is the type of moving average. All of my moving averages are exponential moving average. There are different types of moving averages. Weighted moving average, simple moving average, exponential moving average. I think exponential moving average reflects the data the best, given that it gives certain weights to each data point and doesn't exclude all data from the calculation. I wanted to check if it is possible for you to include in your weekly report a performance of setup of your charts. I guess this is the percentage of chart patterns that reached its price target versus the failed ones. In our last, the previous webinar, I have discussed those numbers, but I will work on this to make it a file that is accessible almost every week. Thank you for the suggestion. Can the ascending or descending triangle be trend reversal patterns? Descending triangle can be a top reversal, yes. But again, I would like to see a descending triangle when it is completing it. It's also breaking down the 200-day moving average. So sometimes you see descending triangle at the top of a trend, but this actually turns into a downward channel and doesn't materialize into a significant downtrend. So it is best to see a descending triangle at the top, also breaking down the moving average, the 200-day. Same thing applies for the ascending triangle. If it is going to be a reversal, we are going to ask the price chart, what are you actually trying to reverse here? So it has to be reversing a clear downtrend, and that reversal can take place only if the stock is moving into a clear uptrend. And that uptrend for me is anything above the 200-day moving average. Yeah, can you discuss success rate for weekly setups versus daily? Now, recently I started adding the daily setups. Hopefully when we load those numbers on the website, we will separate them as daily and weekly and have a look at them. But as a general rule, the shorter the chart pattern, the shorter the time frame, the higher the probability of failure, because longer term chart patterns that form on long-term price charts shows a longer history and participation versus the shorter term. And shorter term, as you know, in today's market, it's much more easier to manipulate. Sometimes a simple news effect can violate the chart pattern. So too short term is not good, especially intradays. I usually avoid looking at intraday price charts. If the handle is a bit above the cup, is the breakout level above the cup or above the handle? Well, the handle should be above the cup, as the cup, according to cup with handles definition, and the breakout level should be anything above that horizontal boundary that connects the peaks. Okay, so when you post a breakout alert on the website, is the red number dotted line a negation level? Or exactly, this is what I have tried to explain in the last two slides. It is the chart pattern negation level. I'm not reporting initial stop loss, because initial stop loss, as you have watched from this presentation, would be different for different traders, for different risk profiles. Question 7. What is the ATR setting you use, and do you check and adjust stops on a daily basis? ATR setting, you can use 3 ATR or 2 ATR depending on how aggressive you want to be. But if you want to capture longer term trends, 4 or 5 ATR can be used on daily scale. Trailing stop loss moves as new highs are recorded on a daily basis. If the trailing stops moves at the end of that closing, at the end of that day's closing, you have to adjust the trailing stop loss for the next day on your as if it is your stop loss.
Thank you, Axel. That was our last question.
Perfect. So I hope everyone enjoyed this presentation. This was our last webinar of the year. I would like to thank everyone for joining and wish you happy holidays and a successful new year ahead. And thank you, Jolene.
Thank you, Axel. This was a fantastic webinar. Thank you again for everyone for joining us and being TechCharts members. We hope you have a fantastic rest of your week. And again, Happy New Year.